to this edition of Money in Motion video blog. This is Dan Perkins, and thanks for watching. We've got a lot to cover today, so let's start with our three indicators: gold, crude oil, and interest rates. Crude oil has been collapsing, is a good word. It's around $87 a barrel now, and the spread between West Texas Intermediate crude and Brent North Sea crude has spread. The spread is narrowed to about $3 and change. If in fact Brent at 91 is including a $15 a barrel terror premium for what's going on in the Middle East, then the true price of crude oil would be $91 minus 15, which would be in the neighborhood of $74, $75 a barrel. At those levels, there isn't a country in the Middle East that can break even on the price of Brent crude. If Brent crude were to fall to 75, I would expect to see West Texas Intermediate crude somewhere in the neighborhood of 72 to 71, which means that for a lot of us, the price of gasoline at the pump is going to collapse. I would expect, if those targets are met, that we would see gasoline prices in the neighborhood of $2.50 to $2.60 a gallon. The energy sector has come under tremendous pressure over the last 30 to 45 days because of the drop in the price of crude oil. And in turn, the energy stocks, whether they be the outright companies like Mobil or Exxon or the royalty trusts or pipeline companies, they've all suffered. I think that this is a fundamental shift, and I think what's beginning to happen is that the significant oil boom in the United States is starting to create a significant surplus of crude oil in the United States. And until we can figure out how to get rid of it, meaning getting the ban lifted, exporting it overseas, we're going to continue to build crude oil, and as a result, I would expect to see further price pressures. I'm a little concerned that perhaps things have gone too far too fast, but I would be looking to acquire some additional positions if the pricing was right and it fit within our 5% parameter. So I expect that the weakness will continue with oil. Wouldn't be surprised if sometime before the midterm election the president decides he's going to finish the Keystone Pipeline, assuming that Canada is still interested. And number two, expansion of elimination of the ban on the export of crude oil, which means that crude oil could then be sold out of the United States in the overseas market, and with a very competitive cost structure, we put additional pressure on Brent and on the Middle Eastern oil price. Now let's turn to gold, and we see that we're around 1,200 an ounce, down from a high of about 1,340, down from the ultimate high of 1,920. Again, I would expect there to continue to be pressure on gold as the European economy gets deeper and deeper mired into recession, and the whole world starts to contract, including the United States. So gold as the inflation head is not going to work because there doesn't seem to be inflation. In fact, I think the greatest worry will shift to deflation. So look for further weakness in gold, and look for it to break below 1184, which was its most recent low. Some analysts think it could go to 1,000 to 1,050. That's a long way to go by the pundits who are hawking gold on radio and television, believing that it's going to go to $2,000 by the end of the year. I suppose it could happen, but at the same token, I'm not optimistic that we're going to see gold at $2,000 an ounce. And remember that when you buy gold and you buy it and you put it in your safe or wherever you put it, it doesn't do anything for you. It has to go up in order for you to make an investment return. Next time you see a television commercial for buying gold, look at the chart behind the person quickly, because it comes on and off the screen. You'll see the collapse that has happened from 1900 plus down to where it is today. So not interested in gold, and may not be for a long time. I don't see any inflation on a domestic or on a global basis that would warrant any significant price changes to gold. Our last indicator is interest rates, the 10-year Treasury. Hasn't changed much since our last conversation. Still about 2.5%, but we've seen further declines in European interest rates, which in turn has caused the dollar to appreciate significantly against major currencies throughout the world. We're approaching 125 on the euro, 160 on the UK pound, and I would expect to see further pressure as the economic news and the employment news from Europe continues to be poor. So I don't expect to see interest rates fall much any further, but at the same time, I don't expect to see them go much higher. So we're going to have to be stuck again for an extended period of time in very low interest rates now on a global basis, and it's still not enough to stimulate the world economy to grow. By the time you see this video, many of you will have received your 3 quarters statement and are going to be pleasantly surprised at the return, including the significant decline in the equity markets for the month of September. Some of you have done exceptionally well. Everybody's done well. Everybody's exceeded the target. Almost everybody has exceeded both the Dow and the S&P 500. We did have some sell-off, maybe 3 to 4% in October or in September, and October starting off very weak and extremely volatile. I think it's volatile because people are uncertain about what's going to happen on lots of fronts. What's going to happen with ISIS, what's going to happen with terrorism, what's going to happen to the government in terms of getting more deeply involved in back in the Middle East again. Are we eventually going to put more boots on the ground? Right now we have over 7,000 troops fighting Ebola, and we have less than 2,000 troops working to save the world from the evils of ISIS terrorism. I think this volatility is going to continue all the way through to the midterm elections and perhaps beyond that, depending upon whether the Republicans gain control of the Senate and how much of a stronghold they have on the House. A lot of people are saying now it's going to be 52-48 in the Senate. I guess I'm somewhat Pollyannish in that I hope that it's going to be considerably more than that. I would like to see 55-56 Republican majority in the Senate. It's going to be a difficult time in the markets. They're going to continue to be volatile, meaning up 225 or down 260. I expect that volatility to continue to change. We're at the beginning of the third quarter reporting season, and we'll start to see earnings reports probably within the next week to 10 days. And by the middle to the latter part of the month, before we get to Gilead's earnings, we'll have a good idea as to what's happening in the economy in terms of demand and how it's affecting revenue, gross revenue, and what's happened in the cost structure for American corporations. Speaking of Gilead, I expect to see wonderful earnings, probably above $2. The street's looking for $1.94 to $1.97 for the quarter. I think it's going to be north of $2. And at that rate, we're going to be approaching $9 in earnings this year. And given its price, it's about a 13 price earnings multiple. I think next year can easily make $10 a share. This morning we had a major competitor, Bristol Myers Squibb, withdraw from the hepatitis C market for their applications in the United States. And Gilead should be sometime this week announcing an approval of its single dose tablet for hepatitis C. In fact, it's actually going to cost more than the other dose, but it has even less side effects, it's more effective, and it's going to be very difficult for people to come in and compete in this space. So I look for Gilead to continue to be a star. I look for some recovery, as I think a lot of stuff we have were oversold, but we've held our own very well, especially in this last go-round of decline since the end of the quarter. So I'm looking for some recovery in certain sectors and looking for opportunity. So that's all for now. Should you have questions, please feel free to give me a call. And if you have friends or neighbors who are looking for a real money manager, have them give me a call. This is Dan Perkins, and thanks for watching.